What's good, everybody? Happy Friday. Friday. The markets have closed at all-time highs yet again. This is getting crazy. But before we get started, remember that whatever you're about to see is not construed as financial advice or not to be construed as financial advice or investment advice of any kind. Be sure to consult with a registered financial professional before taking any advice that you see here, any of our other videos, or anywhere else online. Be sure that you're doing the right thing for yourself in your individual situation. Let's get started. So here's the thing. The Dow was up 227. The S&P was at up 18. NASDAQ was up 49. I want to bring in a chart real quick. We've talked about this in previous videos. What I'm going to do is put this over here, and we'll just transition that in. So this is a chart of how quickly the Dow has moved 1,000 points from one increment to the next. And if we go back all the way, not even that far, to 2013 at the bottom here, it took about 200 days. Then the next time it took about 173, 154, 77, 64, 43. The last time it took 35 days for it to move 1,000 points. The one that would be above this also took 35 days. That just happened, actually. And now, as of today, 10 days, less than 10 days actually, since we hit the last $1,000 mark, we are 3/4 of the way there, just better than 3/4 of the way. What does that tell you? It tells you how fast the market's accelerating in these 1,000-point increments. So I'm not saying that means anything. I'm just saying seems like things are picking up some steam out there. Take with it whatever information you want to take out of that. Now, why were the markets higher today? Well, the main focus is again going to be on the banking stocks. The banking sector did quite well. We talked about this yesterday. The technical traders looking at the breakout that you see with that red line there. But the banking stocks did well. We had JPMorgan come out with earnings. Wells Fargo come out with earnings. Both had earnings better than expected. JPMorgan got a little more oomph out of theirs. I believe the stock was up almost 2%. Yeah, a little bit better out of JPMorgan. Earnings beat both top and bottom lines if you follow that sort of thing. The only negative there for JPMorgan was the $2.4 billion charge thanks to the tax reform. Just because of what that happened to them during the whole crash back in the initial financial crash of 2008. That'll go away, but that's the only sort of negative that people saw of them losing a little bit of money off of that. $2.4 billion, come on, no big deal. Wells Fargo didn't do as good because they had their earnings beat, right? They had a great earnings announcement, but they're still working off that scandal. Remember the scandal where, you know, you would go into a Wells Fargo and you would open a checking account. Well, secretly the little employee there would open a couple more for you because she got a bonus for doing that. They're still working off that sort of cloud over their head. That was pretty nasty. And so because of that, they've got extra regulatory charges, extra charges from the, what do they call it, Department of Justice. And so they still have some money to pay. And because of that, investors were like, all right, earnings are doing good, but you guys still kind of suck for doing that to people. So the stock price was actually down a little bit today. Not too big of a deal. I'll tell you what's interesting is gold. If you follow the price of gold. So I'm going to get geeky for about 1 minute here, and then we'll get back to normal. So gold historically, depending on the time frame you look, gold has a negative correlation to the S&P or the markets in general. All that means is that when the S&P moves 1%, over the last 5 years, gold actually moves down about 0.1%. So if you were to say, I want to be involved in the market's performance, I'm going to buy me an index fund and I want to buy some gold just to be safe. Well, really, you're not going to get the market's performance. You're going to get something just slightly less than that. And you've actually increased your risk. You haven't reduced your risk at all. I bring that up because a lot of clients have that situation where they have some kind of S&P exposure, NASDAQ or whatever, but yet they have some gold and they think they're reducing their risk. Well, in reality, you are not reducing your risk and you're actually reducing your potential returns. Today was a good example of that, where gold outpaced the market. This is 1 day, so don't get excited by 1 day. This is the historical outlier, at least over the last 5 years. Longer term than that, don't bust my chops. I know what the correlation is longer term than that. Everything is fine. But I just want to kind of point that out, that gold was one of the sort of sneaky winners today. And if you look at any of even the gold mining stocks, they killed it, up about 2.5%. So that won't get talked about much because we've got a lot of other stuff going on. Keep that in mind. If you see something like that, it's not indicative of what to expect in the future. It's just kind of an odd day. Facebook, speaking of odd days, Facebook can go down apparently, down about 4.5%. At one point it was down about 7%. Here's the deal. Facebook is changing their algorithm. They're trying to promote more community, and we want people to be like friendlier with people and stuff, and we want them to engage with each other and, quote, generally feel better about their experience. Yeah, right. A lot of this came from the government saying, hey, you need to straighten up your act, man. You're going to start putting out all this stuff that's confusing people about the elections and stuff. Politicians get involved, and hence Facebook makes an adjustment. That's the real story there. Nonetheless, so the stock price was down today because investors kind of felt like, well, people might spend less time on Facebook if they're not getting those viral videos of a cop really beating the devil out of somebody, or, you know, somebody hurting a dog or whatever. If all of that goes away and they really just focus on, hey, my friend got a new job and look at her having a good time, and you want to cheer that and engage with that, then investors kind of think, well, nobody's going to go on Facebook. I take a different approach here. This is not a recommendation at all, but I take a different approach. What Facebook is saying is, we're going to push business pages, and we're going to push marketers sort of off to the side and let you only see the good stuff. Well, read through that. What that really means is, hey, businesses, hey, marketers, if you want to get in front of our people now, you got to pay, and probably got to pay a lot more. So I think in the long term, you'll see Facebook actually make a little more money off of this. So the users will be happy. The businesses will have to spend more to get in front of people, and hence that means more money in Facebook's bottom line, doesn't it? And so I think that was kind of a sneaky, clever way for them to say it. Take a little bit of a stock hit now, maybe over the next couple of days, but long term, that could be pretty good for them. Speaking of pretty good, let's talk about Kohls again. We talked about these guys a few times this week. They've been in the news a lot. Today, Kohls gets upgraded by not just anybody, but by JPMorgan and RBC, right? RBC, yeah, two big analyst firms that when they say something, people listen. So JPMorgan actually raised their price target up to $72, which gives you another almost 13% from here. The reason was they really believe in what Kohls announced yesterday that they were doing, which was reducing the size of their footprint inside of the store, and then all that free space around that Kohls isn't going to use, they're going to find a grocer, or they're going to find a convenience store to sell like hot dogs and stuff. So very cool. So I don't know. I don't really believe in the idea here. I'm not sold on this yet. I kind of view it as more of like a Hail Mary play for Kohls. But obviously the analysts disagree, and they study this company. So I'm going to listen to them for now. Here's the thing. Going forward, it is earnings season. We had Wells Fargo, JPMorgan. We talked about that. We've got Citigroup up on, Tuesday. The markets are closed on Monday. So Tuesday, we've got Citigroup coming up, and that's going to be the focus. Now, if you want to get a little geeky here for a second, the S&P is made up of 11 sectors. We're talking retail, financials, transports. You get what I'm saying. So 11 different sectors. What happens in earnings season is they'll analysts look at the 11 sectors, and they put essentially an earnings growth or decline on each sector. This time around for this earnings season, almost every analyst is expecting that all 11 sectors will actually show increases in their revenue and their earnings. That's setting the bar really high. If even one of those sectors disappoints, that could be the thing that finally makes the markets take a little bit of a break. However, if all 11 sectors do show growth and positive future growth and everything, could be a real catalyst for this market, right? I mean, you think it's extended now. We'll have to see. Basically, that's it. In the S&P 500, we've got some late movers actually here. Something going on with Viacom. If you follow Viacom, CBS maybe thinking about working out a deal together. The stock is up about 10% here just right before the close. And Lowe's, it appears that Lowe's, the retailer, Home Depot and Lowe's. So somebody taking a very large stake in Lowe's, that stock just shot up. Those two are your best performers in the S&P, followed by Kohls being right there next to it. So that's about it. A lot of geeky stuff today. I hope that doesn't bug you. I just kind of like to give you an update about stocks that may be affecting your retirement investments. Of course, if you have retirement investments and you're looking for someone to help you, hopefully you'll consider Jazz Wealth. The logo should be on the screen here shortly. And look, I really appreciate you guys watching. I'll be gone for the weekend. Monday, the markets are closed. Remember that. And we'll see you again on Tuesday. Enjoy.